To a value investor, investments come in three varieties: undervalued at one price, fairly valued at another price, and overvalued at still some higher price. The goal is to buy the first, avoid the second, and sell the third. Value investors should completely exit a security by the time it reaches full value. Owning overvalued securities is the realm of speculators. Value investors have to be patient and disciplined. But what I really think is you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow-up is because of leverage. People should be highly skeptical of anyone's, including their own, ability to predict the future, and instead pursue strategies that can survive whatever may occur. We worry top-down, but we invest bottom-up. When all feels calm and prices surge, the markets may feel safe. But, in fact, they are dangerous because few investors are focusing on risk. In a crisis, stocks of financial companies are great investments because the tide is bound to turn. Massive losses on bad loans and soured investments are irrelevant to value. Improving trends and future prospects are what matter, regardless of whether profits will have to be used to cover loan losses and equity shortfalls for years to come. In investing, it is never wrong to change your mind. It is only wrong to change your mind and do nothing about it. Loss avoidance must be the cornerstone of your investment philosophy. Value investing is simple to understand but difficult to implement. Value investors are not super sophisticated analytical wizards who create and apply intricate computer models to find attractive opportunities or assess underlying value. The hard part is discipline, patience, and judgment. Investors need discipline to avoid the many unattractive pitches that are thrown, patience to wait for the right pitch, and judgment to know when it is time to swing. Investment success cannot be captured in a mathematical equation or a computer program. In reality, no one knows what the market will do. Trying to predict it is a waste of time, and investing based upon that prediction is a speculative undertaking. While some might mistakenly consider value investing a mechanical tool for identifying bargains, it is actually a comprehensive investment philosophy that emphasizes the need to perform in-depth fundamental analysis, pursue long-term investment results, limit risk, and resist crowd psychology. Successful investors like stocks better when they're going down. When you go to a department store or a supermarket, you like to buy merchandise on sale, but it doesn't work that way in the stock market. In the stock market, people panic when stocks are going down, so they like them less when they should like them more. When prices go down, you shouldn't panic, but it's hard to control your emotions when you're overextended. When you see your net worth drop in half and you worry that you won't have enough money to pay for your kids' college. The overwhelming majority of people are comfortable with consensus, but successful investors tend to have a contrarian bent. Successful investors tend to be emotional, allowing the greed and fear of others to play into their hands. By having confidence in their own analysis and judgment, they respond to market forces not with blind emotion but with calculated reason. Successful investors, for example, demonstrate caution in frothy markets and steadfast conviction in panicky ones. need. The very way an investor views the market and its price fluctuations is a key factor in his or her ultimate investment success or failure. Do not suffer interim losses, relish and appreciate them. The prevailing view has been that the market will earn a high rate of return if the holding period is long enough, but entry point is what really matters. Typically, we make money when we buy things. We count the profits later, but we know we have captured them when we buy the bargain. A simple rule applies. If you don't quickly comprehend what a company is doing, then management probably doesn't either. Never stop reading. History doesn't repeat, but it does rhyme. If you can remember that stocks aren't pieces of paper that gyrate all the time, they are fractional interests in businesses, it all makes sense. Over the long run, the crowd is always wrong. Patience and discipline can make you look foolishly out of touch until they make you look prudent and even prescient. The stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. In a rising market, everyone makes money and a value philosophy is unnecessary. But because there is no certain way to predict what the market will do, one must follow a value philosophy at all times. We are big fans of fear, and in investing it is clearly better to be scared than sorry. The way to maximize outcome is to focus on the process. A value strategy is of little use to the impatient investor since it usually takes time to pay off. Targeting investment returns leads investors to focus on potential upside rather on downside risk rather than targeting a desired rate of return, even an eminently reasonable one. Investors should target risk. Graham's wonderful sentence as, "An investor needs only two things, cash and courage. Having only one of them is not enough." Value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. Few are willing and able to devote sufficient time and effort to become value investors, and only a fraction of those have the proper mindset to succeed. The single greatest edge an investor can have is a long-term orientation. Investors should always keep in mind that the most important metric is not the returns achieved, but the returns weighed against the risks incurred. Ultimately, nothing should be more important to investors than the ability to sleep soundly at night. The best protection against risk is knowing what you are doing. Risk is not inherent in an investment. It is always relative to the price paid. Uncertainty is not the same as risk. Indeed, when great uncertainty such as in the fall of 2008 drives securities prices to especially low levels, they often become less risky investments.